Welcome to the Source of Commercial Real Estate, where we discuss all things non-residential commercial real estate, including finding and funding deals, market intel, finding a competitive advantage, and using real estate to live the life that you want. I am your host, Jonathan Hayek, and today I am talking with Jason Maier, Senior Vice President at Northmarq. At Northmarq, Jason provides clients with the benefits of his expertise in management and development across multiple property sectors, providing clients with practical, analytical experience and ability. Maier has represented some of the most prominent buyers and sellers, institutional and private, in the acquisition and disposition of retail, office, and larger portfolio properties. Prior to joining Northmarq, Maier served as Senior Director at Stan Johnson Company. Before that, City Sales Commercial Group, Massey Knakal Realty Services, and Castle Realty. In addition, he pioneered Eagle Eye Investment Trust, a private equity fund investing in national credit tenant, and development of new single-tenant pad sites. Jason brings a ton of experience in commercial real estate. Jason, how are you today?
I'm fantastic, Jonathan. I'm fantastic. Thanks for having me.
Of course. Sincerely looking forward to this conversation. Jason, why don't we just get started with you telling us about your experience in real estate, what got you into real estate, and what your work looks like today?
Well, background in real estate, I've been in commercial real estate for, when I say it, it's kind of scary. I guess the gray in my beard comes out. So, for just a little over 23 years. I actually began my career on Wall Street and got my Series 7, my 63, and was halfway to my general principles license. I spent a little time at Bear Stearns, may they rest in peace. But I quickly realized that I didn't love the equities market. The fundamentals weren't as attractive to me as commercial real estate was. My father was a developer and a general contractor. So naturally, the first thing I tried to do was get away from the family business. But, as Michael Corleone would say, every time I try to get out, it pulls me back in. But I fell in love with real estate. And when I finally decided to get into real estate, first thing that I did, one of the better decisions that I had made was to start at the bottom. Because I really wanted to learn the product class from the bottom up. So I started renting apartments on Manhattan's Upper East Side, running around with my little backpack and showing apartments. But that really gave you a sense of what the renters were looking for. And I think as soon as you understand, who your customer is, it gives you a better opportunity to understand a lot of the other more intricacies in terms of what affects value. After about 6 months, I moved on to selling condos and co-ops in Manhattan, and I completed a few transactions. And then I quickly made a move to leasing. I didn't really have an interest in leasing, but I wanted to understand what retail tenants were looking for, what office tenants were looking for. So that pretty much sums up the first year and a half of my real estate career. It was kind of just a hodgepodge of jumping around from the different areas. And the real mentality was you really need to understand the end use of what the product is to get a better understanding of the market that you're entering. I quickly sold my first 6-story walk-up building on Manhattan's Upper East Side. And then I went and begged Bob Knakal and Paul Massey to hire me at Massey Knakal. For anybody who's not familiar, Massey Knakal was, and in my opinion, will forever will be the greatest investment sales shop that ever existed. They utilized the territory system where every broker became an expert in their territory. So it was kind of either product specialization or it was market specialization. And I think, Massey Knakal had really epitomized what it means to be an expert at something. So that mentality kind of followed me throughout my career. After I left Massey Knakal, I took a role as chief operations officer and ran the day-to-day operations for a portfolio of elevated buildings here in New York City, in Brooklyn, and Manhattan that were owned by Sentinel, one of the larger multifamily operators in the country. There was during the brokerage time at Massey Knakal, there was some exposure to triple net leases, which is now what I specialize in. And there was a certain love that I gained for single tenant net lease, kind of the simplicity of it. And what had really struck me was over the course of selling all of these crazy value add opportunities where you kind of had to really dig in the dirt and work hard to bring value. the same type of returns that were generated in the multifamily space, with the insane amount of effort that went into operating multifamily buildings, a lot of my clients had generated in deals that we had done together in triple net leasing. And I saw a real opportunity to become a specialist in a product class that I finally fell in love with. So I guess you could say after 7 or 8 years in commercial real estate, I finally found a home, and I found a sub product and a subcategory that I really, really fell in love with. And I'll kind of skip through the Eagle Eye Investment Trust, which is an entity that still exists, but a short touch on that. A very wealthy client of mine who was one of the larger private shareholders of Norfolk Bank when it was bought out by Capital One, finally had an exit window and sold about $150 million of his stock in Norfolk, technically Capital One, and asked me to assemble a portfolio of triple net lease properties. That gave me exposure to Stan Johnson Company, and we went out and we built a little fund together with some other private investors, and we went out and acquired a bunch of triple net lease properties together. I put in some of my money, obviously mostly theirs, $100 million plus, along with some other private investors. Unfortunately, he had a heart attack and passed away in mid 2010. And that kind of just left me unsure about what the directions were going to be. Some of the family members wanted to liquidate the real estate and turn it into cash to do what they wanted to do. And if you think back to where we were in 2010, equity was really hard to come by. I mean, we were just in the beginnings of the road to recovery. Three of the properties that I had purchased for the fund were represented by Stan Johnson Company. And in a conversation I had with the then president of Stan Johnson Company and Stan himself, yes, there is a Stan Johnson, we had some conversation. Well, what are you going to do now? I say, yeah, I really don't know. I said, I'm probably going to go back to doing, what I've always loved and what I did best, which was investment sales. And they were like, well, we'd really love to open up a New York office. The conversations progressed, and in 2011, I agreed to be the founding member of the New York office for Stan Johnson Company, which was just a really, my values and Stan Johnson's values are aligned in every way, shape, and form. So together we opened the New York office. We grew it to a 35-person team. Out of the New York office, we do about $1.5 billion a year in commercial and investment sales. And in September, Stan sold Stan Johnson Company as a whole to Northmarq. So now we are Northmarq, which is a Pollard family of company, which is really fantastic. Having all of the new verticals and product lines available, debt, residential, equity, has just really increased our capabilities. So that'll give you the update on where I'm at.
Great. Wealth of experience. I think it would be helpful to frame the conversation in terms of a recent deal that you did. So earlier this year, you closed a deal in St. Augustine, Florida.
Sure.
It was a grocery-anchored triple net retail center. Can we just kind of talk about the specifics of that deal?
Yeah.
Who you represented? Just describe that deal. I think it was a really interesting deal.
So, the dynamics of that deal are really interesting. I'm not going to mention names of clients. I originally sold a Mariano's in Chicago, in Crystal Lake, to one of my favorite clients, greatest guy ever. And we had, fights back and forth, and I kind of threatened to fire myself as his advisor if he didn't buy it. I just saw tremendous value in Mariano's. Mariano's, for those not familiar, is a very high-end luxury grocer, very much like a Wegmans, very much like a Whole Foods, but with a lot more prepared foods, and also usually has a Starbucks kiosk in it. At that time, Mariano's, which was a private grocer, was being bought out by Kroger, and Kroger is the largest grocer in the country with an investment grade rating. And I turned to Mike and I said, the ink isn't really dry yet on the acquisition. We're really getting great value here in cap rate. Crystal Lake is a very expensive area. I really see tremendous value. And he says, nah, we're never going to make any money with this thing. And I fought with him, and finally he agreed, and he succumbed, and he followed me, and he bought it.
So
Um,
can you talk I'm a value add investor, and
sure.
so when I think about a high priced asset like I'm sure this traded at a low cap rate, but for some reason you saw value. So can you talk about the back and forth about why the buyer thought, oh, we're never going to make any money in this, and why you saw this is a great deal?
Sure. So, he felt that the asset was too stable. The increases weren't significant enough. He was looking for something with a little bit more pop. There really weren't tremendous base term increases, but I believed in the area, and I just felt, where we were in the market and where we were in the cycle, we really were going to see some compression in the cap rates moving forward, provided that interest rates remain stable. Because of the quality of the tenant, we were able to take out, 10-year interest only loans and generate cash on cash returns going in that were north of 7%. So, to understand the dynamic of the deal, it was really an asset preservation and an income generation play. He's a developer, and in his mind, I was brought on because I really need to smack him across the face pretty hard, and explain to him the whole idea that we were trying to achieve here wasn't to knock the ball out of the park in appreciation. It was really to have safe, stable income, as he's kind of winding down a little bit, and the safety and the security of the credit behind the tenant. But I still felt that because of what was going on in the area and in the market, and the fact that it was Kroger and it was Mariano's, that there's always going to be an investor, because of the limited amount of high quality product like this. When they do come on the market, they'll trade at a premium. We had really caught that deal super early, so it never really had the exposure to the market to generate a lot of competition. So I just said, what's the deal number here? Like, what do we have to do to take it off the market? And the number that they gave me, I just saw value. I said, I think this thing would trade probably 50 to 75 basis points lower if it was really aggressively marketed in a bid process. The fact that we're taking it before a single email blast has been sent on it gives us this extraordinary opportunity to buy it at a little bit of a discount. But everybody was happy in the deal. The developer was happy. The number was great. The broker that represented him, I think, was really doing the right job by him, because you really never know when you go out to market. And when you have a qualified buyer on a larger deal size, and that the institutions are not getting to your cap rate expectations, and there's a private 1031 investor, the smart move would be to take that deal rather than risk it. And then all of a sudden your best offer, it's kind of like a double-edged sword. When you're trying to make that decision and give your client the best answer what to do, you really don't know. Right. You're kind of guessing. And then it's your reputation on the line at the end of the day. So I've been on both sides of that. So as the buy side here, I just used my experience in the seller representation side of exactly what would be going through the seller's representative head when I made the offer. And I knew the conversation that he was going to have. Sure enough, a couple of years later, I think we closed that transaction in 2018. And then a short 5 years later, I had a very large 1031 in 2022. I represented a private family office in a $240 million 1031. And we needed to assemble some trophy properties. I knew that the client who bought the Mariano's wanted to get out. And I knew that the client who I was representing in the $230 million exchange was looking for something exactly like that. So we made a really nice profit on the sale of that deal, well north of anything that the client ever could have dreamed. But that was where the market was. Again, essential business, Kroger credit. They're just absolutely killing it at that location. Even though they have, I think, 380 parking spaces, they actually asked us to acquire the neighboring automotive dealership to expand their parking, which will kind of tell you about what their commitment is to the store long term. And because he came out of that stable deal, And he was also looking for something that was trophy. When we came across the Publix anchored center in Florida, again, I always just say things are just meant to be. And for that client, who had shifted a lot of his assets down to Florida and a lot from, because he was a New York City guy, and he was a New York City guy who was looking to diversify around the country. So hence we kind of went out to Crystal Lake, Illinois, and then we moved a lot of his assets as well down to Florida. So when this shopping center came up, and it's a high end Publix, so there's a Publix across the street that's your regular everyday Publix. This Publix operates a little bit differently, um, and the out parcels that were there came along as a package. So it's kind of like, look, there's real value when you're buying a deal like this, because really the sum of the parts were greater than the whole. The Publix by itself would achieve a certain cap rate, and then the Starbucks and the other out parcels that came with it. Um, I felt that if we had chopped it up, if we literally just bought it and chopped it up and we were willing to just turn around and flip them, we probably would have made a couple $1 million just by flipping them. Um, and he was looking for something a little bit more management. So again, it was just a great deal in a great up and coming area right across the street. They just built a brand new high school. They just built a brand new middle school right across the street. So you can see from the amount of the development of new housing, from the new schools that popped up right across the street, that what does the future really hold for a property like this, right? This is now becoming the epicenter of retail and life for that area. Um, and from a long-term value perspective, I think that it's those kinds of investments. Again, it's not an overnight business. Real estate is never, sometimes, yes, I buy it and I flip it. Yes, I value add it quickly and I sell it. But for this particular client who's looking at, really enriching his next generation of his children's life and say, okay, I bought something for 25 million and they'll sell it for 50 and I'll cash flow on it and generate a nice, income from it. That was kind of the purpose behind the acquisition. But it was really, in terms of what I do, I would say that type of product is kind of the antithesis of what I look for.
So to clarify, to summarize, the seller of the Marianos in Illinois sold the Marianos. He came to you and said, "Hey, if we're selling this, I need something else to go into." That's when you located the asset in St. Augustine, and so then
Yeah.
he went ahead and bought
Yeah,
the asset in St.
it was a
Augustine.
two-sided transaction, right? First,
Okay.
it was, hey, do you want to sell that asset? I have a buyer who would really love to buy it. And then obviously the next thing is, well, Jay, you're going to have to find me something to buy, So we had to go out there and dig up, what the exchange looked like before we even began, the thought process of selling.
A couple reflections on that. It just goes to show the value of a great broker who knows markets and knows good deals and knows value. So, you knew kind of the profile of this buyer, who's looking for value, and initially saw this Mariano's as, oh, there's not enough value there, not going to make enough money. But he trusted you and he did really well on it. And then he trusted you again to buy this asset, to find an asset, and ended up buying this asset in St. Augustine, which St. Augustine is blowing up. It's a great market. And so I'm sure, in 5 or 7 or however many years he chooses to hold on to that, he's going to do just fine on that. And he'll come back to you, and you'll start the cycle over again to find something else. The St. Augustine deal, was that an on market deal? I personally, I hope one day I'm going to be buying properties like this. I'm not currently. Are properties like that, are they on market? Are they on Crexy and LoopNet? Is there separate? Is there just a network of brokers that that
Yeah,
lists these types of assets? How do you go about finding a $24 million property?
sure. So there's a lot to that, right? So some of it is on the market, right? I've got a team that works for me of hound dogs that are out there digging up, deals. You know, there's a statement in brokerage which they say is, 10% of brokers do 90% of the business, which is a very true statement. And there are some other large teams around the country, and look, it's a business of reputation. in every way that you can imagine. And I think I built a good one over the years. And, especially in the triple net lease universe, because 1031 buyers are coming in and out of the market so quickly. Um, the brokers rely on each other. And even though we're competitors with other firms, we're really good friends with a lot of other teams, and we do a lot of business back and forth. And there's a couple of key brokers and relationships around the country, that they're constantly pinging me as soon as they get something, or even that things that are coming on the market, not even on the market. So, that's one of the benefits that my clients get by working with me is, you not only get the product that we have as a company in advance, you're also getting access to, some of the top producing teams from other firms around the country who, the moment that they have a deal, I mean, I'm talking about off market, like they haven't even signed a listing agreement yet. And they're calling me already. And I'll be honest with you, I don't really remember if that deal was on the market yet or not. I think that there was two of the out parcels were on the market. And then the broker who called me runs the net lease division. And it was actually the local Florida team that was working on that deal, but he called me up and put that deal in front of me. So no, I don't even think that the Publix was even on the market yet when it was sent to us. But I would turn around and probably say a good 70% of the product that we sell isn't on the market, is off market, we co-broke a lot with other brokers. And again, we rely on the brokerage community heavily to deliver the product that we need.
That makes a lot of sense. And that I work with a broker locally. I've probably done 25 or 30 deals, and I've been on the sell side where something is not technically on the market, but the broker says, "Hey, I've got a buyer that fits the profile of, a potential buyer for this property. Do you have any interest in selling it? Because I think I've got a buyer." And then, I say, like, well, now that you mention it, I guess, for the right price, it could be available. So
Sure.
that just sounds like good brokering to me. Can you talk about, I guess, what you're seeing in the market as a whole right now? Let's first talk about sellers.
Sure.
It's, I hear people say the only people that are selling are distressed sellers, people having distress in their personal life or a distressed property. What do you say about that? And what are you seeing in terms of what types of people are selling right now?
Look, there's no secret. It's a rough market right now. These interest rates, they went up so high so fast, that leads to a devaluation of real estate values. It makes it really hard to make deals happen in an industry that largely relies on the debt markets to generate, higher returns. If you're looking at the industry, which is largely 1031 driven, which is why every single time they talk about potentially repealing the 1031 exchange rules, I'm like, I laugh at it. And I've sat down with congressmen and governors and senators numerous times, and I kind of give them the bigger picture of what the 1031 means. And I don't want to go off on a tangent, but 65% of most school budgets rely on transfer taxes for their Department of Education. So when you wipe out transaction volume, you're also wiping out a lot of the sources of the revenue that they rely on to fund their school budgets. So and some of them even have an extra 25 or 50 basis points specifically for their local school districts that are added on that as it's broken down. If you don't have to sell now, you don't. A lot of what we're working on is institution to institutional transactions. I really don't see a lot of private investors, and the ones that are calling me and asking me, Jay, where can you sell this at? And, what do you think you can do? And I'm like, look, if you have the ability to hold on right now, I would wait a little bit for interest rates to come back down, because values are artificially down. Nothing intrinsic to the conditions of the property have really changed except the borrowing rate. So, because it's largely 1031 driven, you're not seeing a lot of influx of 1031 buyers in the market. So that also puts less pressure on inventory, and the institutions are being very selective. So that's kind of like leading where inventory is higher, there's less buyers. It's harder. Some properties are flying off the shelves in some assets, in some asset classes, and others are kind of just staying very stable. The only sellers that we see outside of institutions who have time horizons where the fund is over and now they have to exit, it's not a question. It's just the time is up. They're going to sell. So we see a lot of that. Private sellers, yeah, I think for the most part, they're experiencing some pain and anguish in some other areas of their real estate portfolios, and they really don't have a choice. They have to sell it to generate some equity because when they're looking to refinance, again, without mentioning any specific clients, I have a client right now who has no choice. He's going to sell off about $30 million worth of real estate because he's got some big loans on some larger assets that are coming due right now. And he needs to be able to pay down the debt on those assets because the interest rates right now and the income that those properties are generating are just not really going to cover. So the answer to that question is, yeah. I mean, would you sell a property at an 8 cap or a 7 cap when you could have gotten a 5 cap just 2 years ago, unless you absolutely had to, knowing that if you just carry it through to the next 2 years into the next cycle, when interest rates start coming back down again, that the value is going to go higher. So you're really just agreeing to lose money if you sell now.
Now is as good a time as any to talk about projections. You alluded to this in your answer a little bit. I want to ask about kind of the seller sentiment. You just mentioned, 18 to 24 months ago, you could sell something for a 5 or 6 cap. Today, it's a 7 or 8 cap. And so there are sellers that are in this mindset that, wow, I essentially lost a couple $1,000,000 if I could have sold, 18 to 24 months ago. But now, how are you advising potential sellers? Are you, and this goes into kind of your projections in terms of it's largely interest rate driven. Are you envisioning interest rates coming down in 2024, 2025, beyond? I won't hold you to it, but what's kind of what's your reading of the tea leaves?
A couple of weeks ago, if you would have asked me if the Fed was going to raise rates again, I would have said nobody could be that stupid. But sure enough, here they are, right? It's a bigger question because interest rate hikes don't just affect real estate, it affects the borrowing rates for all businesses across multiple lines. So it's not a way to stave off inflation. It's the dumbest thing I've ever heard in my life because at the end of the day, we do a lot of corporate sale leaseback and corporate advisory. So what I see when I'm looking at balance sheets is literally they're doing what they can to keep their margins the same, and they're just passing the expense off to their customer. It doesn't matter what product that they're selling, whether that's raw product or whether that's finished product to retail. So the whole idea behind raising interest rates to this level, to stave off inflation is just ridiculous in my point. I don't put anything past the current administration to engage in stupidity in terms of economics. I'm more of a free economy type of person, and just let the markets do what they're going to do. And when the Fed starts to, I never like when the Fed starts to really inject itself into business. I think that there's some times where you do have to cool down the economy, and you can do so by raising interest rates by 50 basis points. But if you're looking at the 10-year Treasury going from 1 to 4, a lot of things have happened with some bank failures. There's a lot that affects where we're at right now. So to ask me where I think we're going to be at in the next 12 to 18 months, honestly, I really don't know. I think that there's a lot of more pain that's coming. I always say I like to be the optimist, and I am always cautiously optimistic, or am I bearishly optimistic? I'm bearishly bullish, right? When I always sit there and say, there's always a bear out there who's shouting that the market's going to collapse and one day he's going to be right. It's just a question of, when is he going to be right? I don't know. Right. Right now, the only thing I can tell you is I do sit in an advisory capacity in lots of different areas and companies and individuals and private family offices. And right now, my answer is don't sell. There is not, and that's kind of counterproductive, right? Coming from a broker who makes his living off of, generating commissions. But that's bad advice, right? The bad advice is to sit there and take an asset that's been artificially, reduced in value simply because of where the interest rate environment is just, inherently not the right decision today. As long as you can sit there and hold the property, again, real estate values always go up and down. It's always cyclical. If you study it over any 10-year period, real estate pretty much grows at a stable between 3% and 3.5% annual growth rate, regardless. So if you're just looking at the appreciation of land value, the replacement cost value, and that's something I always keep a close eye on is, what would it cost me to build it today? Right. And you'll see a lot of, deals that are being marketed at below replacement cost, or it's $100 a foot, or it's $50 a foot. Their approaches to value are kind of two different approaches to value, which is the income approach, which is solely placing a cap rate. And I always just say that, when we look at cap rates is a fallacy of value. Cap rates is just a window of what the value of the property is today, just based on interest rates. But that doesn't really reflect the true value of the property, right? Which, again, is the potential, the value of the land, what it would cost you to rebuild it, replicate it, and what the real income that the property can generate. Like, what is really the potential today, the potential 5 years, 10 years, 15 years. So it's very kind of horizonish about when can you bring out value. So my answer to you, to sum it up, is right now is don't sell. Unless you absolutely have to and you're suffering and you need the money for something else. And particularly if you have a triple net lease property, you're not suffering the way other owners are, right? We're talking about single tenant net lease. You have one investment grade tenant or corporate tenant that occupies your property, and provided that he's paying his rent on time every month and you have the safety and security to navigate through uncertain times, why would you want to sell that asset, especially when it's artificially down in its value?
Great insight. Thank you. Thank you for sharing that. Let's talk about sellers. So, talk about seller sentiment. Do you have sellers coming to you looking for distress, looking for great deals? Do you have sellers looking for properties right now?
So
Talk
you
to me
mean, I
about
think you
seller
mean
sentiment.
buyers. I think you mean buyers.
Excuse me, buyers. Yeah.
Right.
Let me pause and reframe that question.
Yeah.
Jason, tell me about buyer sentiment right now. Are buyers looking for distress? Are they coming to you looking for deals? Tell me what your perception of buyer sentiment is right now.
Yeah. So, buyers are always looking for distress. That is a never ending, even in the greatest markets, right? They're always looking for some kind of distress, because that denotes that, there's added value there. They can get a quick deal done. But there are a lot of buyers out there that are just looking, what I would say is not distress, but they're looking for value. So the better answer to the question is, right now, if you can't generate the returns, so let's look at an investment two ways. Let's look at cash on cash return, right? Which is the amount of money that you put into a deal versus the annual cash flow as a percentage. Give you your annual cash on cash return as a percentage, versus your internal rate of return, which is calculated only really after you sell it, which is, the total amount of your cash flows, whatever it appreciated in value, as a percentage of the initial equity investment versus what you took out. So there's the two ways, you're looking at any deal. At the end, you're going to calculate IRR. And it doesn't matter if you were generating a 12% annual cash on cash return. If you end up selling the property at a loss, that 12% is meaningless. So it really matters is, was it a winner or a loser when you sold it, and how much did you make annually over the holding period, right? So what I think all of our clients are looking for today is value. And if that can't come in the way of annual cash on cash return, then what they're really looking for is appreciated value. So let's look at an example, right? If I went out, and let's keep it simple. If I went out today and I bought a Starbucks that was making, $200,000 a year, and I bought it for $4 million. And fast forward to today, and I can buy that same Starbucks for, I don't know, $3.5 million. If I turn around and I sell the property for $4 million because cap rates came down and interest rates came down for $5 million, I made $500,000 in profit, not because anything fundamentally had changed with the property, just cap rates came down. So again, I said that there is a fallacy of value when you start using the cap rate approach to value, but it does affect the today value. It doesn't affect necessarily the income approach on an annual return basis. So what we're trying to do is reformat what really matters the most. So when interest rates were really low, the goal was generate the highest rate of return on my cash I possibly can, and look at the appreciation. Today, we're not necessarily focused so much on the cash on cash return, because the debt service is eating up a lot of the cash flow right now because the interest rates are high. So in order to make a deal work, typically I would say about 90% of the deals that you're buying, your borrowing rate is higher than what the cap rate was that you purchased it at, which is kind of crazy. It's called negative amortization or negative cash flow, any way you want to look at it. But if you can look at that property and say, you know what, I'm buying a $8 million property today for $6 million. That's the way I see it, because when interest rates come back down in 3 to 5 years from now, there's all that appreciation. And when I divide that over my holding period as an annualized basis, I'm going to be really profitable. So that's what we're trying to find. We're trying to find the deals where they got hit hard on cap rate. The value is still there. The security is still there. And as soon as the market gets better, that's going to be the fastest property to recover. The cap rate compression, meaning the cap rates will come back down the fastest on that asset class. Those are the types of assets that my clients are looking for. And of course, the distressed guy who's got to sell because he's got to pay off a mortgage, or he's, getting crushed in one area or the other. But I think fewer and far between the stressed is just, you're just trying to find value and try to take advantage of cap rates and the cap rate environment, which is still tough because the debt markets are not cooperating. I mean, moving over from LIBOR to the SOFR rate, the spreads between, the borrowing. I mean, you're looking right now, if you have the 10-year treasury, above 4, they're looking at a 350 spread, right? So put that into context for your audience. If 4% on the treasury, 3.5% gives you a 7.5% firm on your interest rate. The spreads, when interest rates were lower, most of the lenders were at like 180 or 155 spread. So, 10-year treasury was at 2 and a 150 spread, your borrowing rate was 3.5%. So not only are the interest rates higher, the spreads that the banks are taking, which is how they're making their money, is also widened. So the banks are complicating it too, but to not make them the devils, right? Their risk-weighted return, like all of the money that they're investing, if you can go and generate 6% triple tax-free municipal bonds today, which means that the rate of return that you have to give back to your investors when you're putting money out in commercial real estate, which is a riskier venture, has to generate a higher rate of return just by its very nature of lending money. So that is really what we're seeing a lot today. And we're seeing it play out every day in real estate.
Yeah, 2021, early part of 2022, it was, really a pure arbitrage play. If you could get a 3.5% interest rate, you can buy a 5 cap. Those numbers work. Now, if you're looking at an interest rate of 7.5% and you're looking at properties at a 6 cap or 6.5%, it's really hard to make those numbers work, which means there's got to be some opportunity there. There's got to be some way to bring some value in the long term. So in those properties that you're looking at where there's opportunity and value, what specific characteristics are you looking for when a buyer says, I'm looking for value, I'm looking for opportunity? If there's negative leverage early on, I can live with it as long as there's value long term. So in terms of markets, location, asset class, what are you looking for that means value to you?
Mostly what we're looking for is like underutilized or under leased properties, which is, it takes a lot of expertise to identify those situations. If you're looking at, some larger boxes, that are rented to tenants that are archaic, that are going out of business, that they're not going to survive. I mean, if you take a look right now, Big Lots, no secret, they're not going to survive. I don't know if they survive, but it's very hard to come back. Being in the bulk discount business, when there was supply chain disruption and Big Lots really didn't have the amount of product to sell at a discount because there really was no supply for overstock for them to sell, it kind of makes sense that they're struggling. And for other reasons why they're struggling, I mean, they're a great operation, a great company with an unbelievable management team. And I root for them to pull through this. But like a lot of other retailers that don't make the proper adjustments to the direction where the consumer is going or the products that the consumer is looking for, Kmart, Sears, JCPenney, those are the things. And there's a lot of operators and businesses that are in the space that are just doing a better job. And when you have legacy retailers like a Big Lots leaving a shopping center, or currently in a shopping center, or you have a Belk's, or you have a lot of tenants that are occupying centers where that they're not going to make it and their rent is cheap. That is second that box becomes available, you can re-tenant it with a better caliber of tenant at a higher rent. So, if you want to talk about value, what you're really looking for, I hate to say it, is you're looking for the struggling retailers that you really believe are not going to make it. And in some cases, you can even go and cut deals with them to relocate them or to buy them out of the box, and re-tenant that property with a better tenant or chop it up. Sometimes, again, the sum of the parts are greater than the sum of the whole. So, look, it's interesting when you sit in this chair every day for as long and you look at as many properties as we look at, in a day, let alone what we see in a year. You do start to really get it. And I believe that we play an integral part in identifying opportunities for our clients to go and take advantage of it. And we get to participate on both sides, right? Just putting them in it and then taking them out of it. So, to find value, if you're looking for value, the answer always comes in, you have to just have vision, right? That's the most important thing. But vision may be not just enough, right? And vision and expertise. You really have to know what you're doing. I always say, if you go into any neighborhood in the country and there's an epicenter for a suburb, I love suburbs, by the way, suburbs all across America, they all bear the same common theme. Construction may change, the weather, some of the landscaping is different, right? But ultimately, they all behave the same. Lots of rooftops, lots of houses, one really great shopping center, a couple of other pad sites. And inevitably, as you drive through all of these little suburbs and all these neighborhoods, there's always a couple of really, there's a plumbing supply guy. There's an old nursing supply business where you're like, smack dab in the middle of, Starbucks, Chick-fil-A, and Shake Shack. There's still this old guy who's been holding out forever, right? He's going to retire one day. That's the guy you got to stay on top of, right? That's the property you got to keep on calling. Because eventually one day that no will become a yes. And those are the ones that you have an opportunity to value add.
Jason, we're getting to the end of our conversation here. You talked earlier about working with some really high net worth individuals. You mentioned one of your clients having a $240 million 1031 exchange. I hope to one day come to you with a $240 million 1031 exchange to execute. When I've got that problem, you're my guy. So talk to me about strategies you have for networking and meeting these high net worth and ultra high net worth people. There are people listening, there are brokers listening who want to network with these people. There are operators who want to raise money from these people. So I'll just leave it open. What suggestions or strategies do you have for networking with these people?
How many of my trade secrets am I going to give up? I don't know. Honestly, I've been around, like I said, I've been around a long time. The relationships are advisory. They're not broker, and I always say, the difference between a broker and an advisor, the broker's job is to sell you anything to earn a commission, and an advisor's job is to make sure that you're buying the right property. Our process is very, very methodical. In terms of how we take our clients through things. We know a lot of times we're brought on by other brokers who represent them. If you take a look at New York City, right? My relationships at Massey Knakal and relationships with those brokers who are representing large multifamily owners and office building owners and private family offices, and they're here in New York, and they're selling what was a very management intensive asset, and they're looking for, more passive income. They're looking to retire for whatever reason, or they're just looking to diversify and leave New York, and see what the rest of the country is like, but not being present in those markets. From a management perspective, they felt that, a triple net lease property where the tenant pays all of the expenses and they just get a check every day, and to see the growth and the appreciation. You take, like, Durham, North Carolina, or Charleston, Charlotte, Texas, Arizona, these are really exploding markets that are growing, and so is value. So, they'll really look to someone like me who can guide them and help them make the right investment decision. And I always ask the question, I said, well, what's most important to you? Is it, income generation? Is it asset preservation? Is it growth? What are you really looking for? We have to have a hierarchy and say, let's list that in order 1, 2, 3. And let's start with what's most important to you. And then from there, we go out and we'll build a portfolio or find a property around that. And again, it's a lot of the relationships that I have with, brokers, attorneys too, by the way. I always felt that brokers are really, I would use the term delinquent in really building relationships with the opposing attorneys. You got to like them. They got to, actually, I would say nobody has to like anybody in the transaction, but it's always important if you can help build relationships, especially when you're dealing with real estate attorneys. Real estate attorneys each have hundreds of clients. So, if you can prove to the attorney that you're a smart guy and you're trustworthy, and, the sacredness of a referral would be safe with you, and even more than just sacred is that, it's safe and you're going to do the right job by their client, they'll feel comfortable to recommend you. So we have a network of real estate attorneys. We also deal with a lot of FAs, right? Financial advisors, very high net worth, in private banking institutions that will remain nameless, with their clients, where they're seeking diversification, and our asset class is just perfect for a very high net worth individual who's not in real estate, who owns stocks and bonds and commodities and other things, and they are looking to deploy some money into something else to just eliminate too much exposure to one segment. And the triple net lease segment is perfect because, again, it's totally passive mailbox money. And all you have to do is get a check every single month, and the tenant manages the property. So, that kind of creates a lot of the network of people that I've created that, that keep me very busy, from the high net worth side. Again, it's the same answer. I mean, we're dealing with real estate, and we're dealing with, very large assets. And I think, 23 years in the business, 13 years here at Stan Johnson, now Northmarq. I've worked on some really big transactions. Your name gets out there and people start to see it all the time. So that kind of creates its own, recognition all of its own.
You talked about the difference between a broker and an advisor. A broker is someone who tries to get the deal done, tries to make the sale. An advisor is what you view yourself as, someone who wants the best for their client, will advise them to not sell right now, even when that's your paycheck. How does an investor tell the difference between a broker and an advisor?
I think you already know the answer to that question, right? I would tell you there's probably $200 million of deals I haven't done, commissions I haven't made, because I refused to sell my clients a property or show them things that were what they were asking me for, but I just don't believe in it. And I just won't show it. I'm like, there's plenty of other brokers who will sell you that kind of property, but the problem is my reputation and my name will always go along with that property. If that deal doesn't work out, that will follow me for the rest of my career. Mm-hmm. That will always be, that guy Jason sold me that piece of crap, and look what happened. That thing those come back to haunt you, right? So I think, I hate to use the car salesman analogy, but there's a really big difference. Like, and when you go to a car dealership and there's a guy who's working there, and he's trying to help you, versus a guy who's, just trying to hard sell you and just trying to, drive you crazy. So, he's asking you the right questions and he's showing you product that makes sense, right? And he cares about what you care most about, right? So for us, we individually re-underwrite every single asset. for our clients. And I always ask myself the question, would I buy it? Would I buy it? Do I want to own it? Would I want to give this to my kids? Would I feel safe in this particular property? What do I really think? I think we can only do our best to try to make the best decisions, together with our clients. And I would tell you that, like anything else, it's about your reputation, what you stand for. I've always, I tell my son this, and I tell everybody who works for me the same thing. I said, you don't ever need to look up to anybody. Spend every single day of your life becoming the person that you can look up to, and make your decisions that way. Look at every single client that way. That each client and each transaction is something that you have to walk away and be proud of or embarrassed of. So the difference between a broker and an advisor, your advisor should be very proud of the job that he did. Your broker, because there's a lot of negative connotations to that word broker, right? And some of it is deserved too, by the way, because I come across a lot of, I hate to use the word skeevy, but really horrible people in this industry. I think majority of the people are really good, caring, great reputation with high integrity. But again, like any industry will get a bad rap, because of some bad apples. But don't be that guy is my answer. Be the latter, because if you want a long reputation, you want a long career in this industry, I promise you your reputation will stay with you forever.
We're going to leave it there. Jason, this has been an enlightening conversation. I love talking about commercial real estate with you today. If a listener wants to reach out to you, where would you like to send people to connect?
I mean, you can always, find me on LinkedIn, Jason Maier at Northmarq. And I think probably the best place is to hit me up on LinkedIn. I'm not a big social media guy, so there's no Instagram, TikTok or Facebook. I'm maybe one of the only people that's not on Facebook. And obviously through my email address at jmaier@northmarq.com.
Perfect. You're not missing out on much by not being active on social media. Jason, thank you so much for your time, sharing your expertise in commercial real estate. Thank you so much. Listeners, I appreciate you listening. If you want to reach out to either one of us, please do so. We love talking about commercial real estate. I appreciate you. Until next time, take care.